Does timing the stock market work? In this video, we're gonna look at the 5 biggest crashes in the last 35 years. And what if you had been investing steadily over that entire time? What if you had invested at the absolute perfect timing? Or what if you had invested at the worst timing? Let's see. So if you started investing at 25 and you retired at 60, you'd be invested for 35 years. So if we go back and we look at the last 35 years, there's been 5 major crashes in the stock market. The first one being the crash in 1987 called Black Monday. Then in 1990, the Kuwait War and the oil crisis that came along with that. Then in 2000, we had the dot-com crash. Fourth crash was the subprime mortgage crash in 2008 that led to the recession. And the fifth one we're gonna look at is the crash the stock market took from COVID-19 in 2020. So for this video, we're gonna have 3 different types of investors. They're all gonna invest the same amount of money, $210,000, over the course of 35 years. This would equal out to $6,000 a year. Hint, hint, that is the maximum Roth IRA contribution that you can do right now, $6 grand a year. So for the first guy, the steady investor who just continually invests, doesn't really wanna play the market or follow it too much. He just knows that over time, if he keeps contributing, he's gonna be all right. He does $6,000 a year in the S&P 500 from year 1986 to year 2020, 35 years. Through all the highs and lows of the big stock market crashes we talked about, at the end of 2020, he would finish with $1.66 million, which is really good. Most of the population would be able to live on that the rest of their lives without any complaints. The second person we're gonna look at is the perfectly timed investor. He continually saves $6,000 a year and invests it at the very bottom of a crash at the perfect time so it can grow its maximum amount. And right before a crash, he knows the exact day to pull out all his funds, let the market crash, and then reinvest them at the bottom. If you timed it absolutely perfect, you would finish with $2.89 million. But let's compare that to our third person who's the worst timed investor ever. This person continually saves up $6,000 a year and invests it at the very worst time. So basically right after they invest their money, the next day it plummets. But because this person keeps their money in the stock market and it continues to still grow and bounce back, after 35 years, the worst timed investor finishes with $1.04 million. So what does this mean though? Let's look at some things to consider. If you look at the worst timed person, even if you invest at the absolute worst times throughout your life, this person still ended up with $1 million investing in the S&P 500. You really can't mess this up. The big thing is you just have to put the money in there and start and leave it in there untouched for a period of time. Compare the worst time person to somebody who saves all their money in a bank savings account because they're too scared that the stock market's gonna crash and they're gonna lose everything. If you save $6,000 in a bank savings account for 35 years, the average interest rate is 0.05%. That person would finish with $211,000, nowhere near compared to $1 million. You can retire on $1 million, you can't retire on $211,000. Now looking at the perfectly timed investor is really enticing because obviously they did better than someone who steadily invested. But the perfectly timed investor is unrealistic. 88% of actively managed funds by finance professionals underperformed the S&P 500 the last 15 years. That's not just match the S&P 500, that's did worse than the S&P 500. And statistically, you have a 1% chance that you're gonna beat the S&P 500 every year for 10 years in a row. The odds are not good that you're gonna be able to play the market and trade so that you're gonna actually beat just steadily investing. This is a cool example that plays into that. What happens if you miss the 10 best days in the last 35 years of the stock market? Because the best days in the stock market usually come right after a big crash like the recession in 2008 or after Black Monday in 1987. So our guy who timed everything perfectly finished with $2.89 million. But if he held off for a little bit too long before jumping back into the stock market and he missed just 10 of the best days, he would have only finished with $1.3 million. That's less than half of what he had, and that's worse than the person who steadily invested. And if Mr. Perfect Timing missed the best 20 days, he would only finish with $802,000, which is even less than the worst timed investor. My point is this: time in the market is always going to be timing the market. It's better to stay in the market and be steady and let time cure it and grow it and get compound interest. And if you never started investing, you're looking for a place to start, a Roth IRA is super easy to open up, and it's a great place to start investing. I have a video, which I'll put the link right here or in the description down below. You can click it and watch that tutorial. And if you currently are investing, that's awesome. Keep it up and find ways to squeeze out more money to invest. Your future self will thank you. That's all for this week's video, guys. Thank you so much for watching. Please go ahead, hit the subscribe button. It helps this channel, it helps me to keep making these videos, and I'll see you next week.